Non-systemic risk, we have gone through these concepts, that risk that does not affect the whole system can be virtually eliminated by diversification. We have seen these, so I'm not going to repeat these concepts. It is within every investor's power to do so, whether in equity portfolios or in mutual funds. The lesson is only go for diversified products. Mutual funds are not going to bother about investment. Mutual funds are going to bother about how much money we can collect. So if there's a totally crazy investment idea, like a sector fund, a thematic fund, totally crazy, but that is the flavor of the moment now. And they think by coming out with a fund that can offer that avenue of investment to investors, we can collect a lot of money, they will do so. They will come out with that fund. Because they come out with that fund, should you invest? Or should you as an advisor recommend it to somebody? Like your alternative investment funds and all these crazy things that happen. They'll be couched in nice language. Alternative investing in wine, investing in artworks, investing in some antiques, whatever it is. That this can be done for a small portion of your money as a further diversification. The questions to be asked are those things that they are investing in investments? Are they investments at all in the first place? Because an investment produces income. So, as Burton Malkiel calls them, they are things. They are not investments. They are things. They cannot rise to the extent of investments. If somebody has a way by which, let's say, a professional who will only collect very valuable works of art and then regularly exhibit them at various places in the world and will not exhibit them free but will charge something for them, then we have to see what is the kind of income they are able to generate and what is the kind of expenses they have on insurance against damage to the artworks, theft of the artworks, deterioration of the artworks over time, restoration work if any, cost of transportation. It's not like just dumping them in a lorry and saying, go. It'll have to be protected, so many things. Then we have to see whether all that works out. And then if there's a meaningful income flow, then somebody may be able to convert that into an investment. But just buying artwork, storing them, and depending on the change in price value does not make it an investment. Just does not make it an investment. So everybody can diversify. Systemic risk. Systemic risk is what affects a system. For example, a change in tax law, war. The whole system gets. This is something very, very important to understand. So let's try to understand it. For some reason, maybe even personal inability, I've never been able to convince investors or sort of get this idea into investors' heads. So let me make one more attempt at this. What can you do to control risk? Is it within your power to control risk? And I like to call this concept the risk ladder. When I explain it, a lot of people appear to understand. But later on, their behavior does not sort of seem to, suggest that they internalized it. Doesn't matter. When you invest in very dangerous things like derivatives, for example, a futures contract, your risk can be, this is the risk. It can be greater than 100%. So I have a lakh of rupees in my pocket. I invest in one company, what we call concentration. I believe that Larsen & Toubro is the greatest company in India. Why should I invest in a diversified portfolio where Larsen & Toubro is one of the companies, when I can put all my money here? So I have my 1 lakh, I put my 1 lakh here. What is the worst thing that can happen to me? Obviously, the worst thing that can happen to me is even the best possible company in the world can go into liquidation for whatever business reasons, and if and when it does go into liquidation, if I'm still holding on without selling to the bitter end, I can lose my 1 lakh. I cannot lose more than that. So my loss is 100%. This itself is a bad situation. But if a stockbroker says, you love L&T so much, you have got 1 lakh rupees, why are you not buying more? Because I don't have more than 1 lakh. Okay, let's convert this now into a futures contract. Give me your 1 lakh rupees as a margin. It's like a safety deposit. I will allow you to buy into 5. That means 5 lakh rupees worth of this company. Here what you bought are actual shares. The company went into liquidation, you lost your money, that's your bad luck. But you bought shares. Here you had this money. Instead of buying shares, the broker now gives you a position. You have not bought 5 lakh worth of shares, but you have kept this 1 lakh as a deposit, and against this 1 lakh you are able to leverage. It's like a housing loan. I've got 25,000. The bank is willing to give me 75,000, 75%. So total 100%, I'm buying my house. You have bought it, it's not your house. It is more of the bank's house than yours. When you get to 75%, I've repaid the loan, then you can at least say, see, out of 2,000 square feet, 1,500 square feet is mine. Only 500 remains to the bank. So here, 1 lakh is yours. You're not getting a single share in your demat account, but you're getting a position of 5 lakhs in the market. That's essentially a futures contract. Now in this case, if L&T falls by 30%, 30% of 5 lakhs is 1,50,000. Immediately what has happened is, the broker will ask you for further money. If you say I have no money, he will immediately adjust the 1 lakh out of this 1,50,000 against the initial margin that you paid. And you will still be minus 50,000, for which he may take action against you. Which means you had 1 lakh, you played in the futures market to the extent of 5 lakhs. The company did not, here it had to go to 100% for you to lose your money. Here it's only a 30% fall. And a 30% fall delivers a knockout blow to you, more than the money that you have. That is what we mean by you can have a risk of more than 100%. That's why Warren Buffett said, derivatives are financial weapons of mass destruction. So when you compare just these two, isn't this where you're losing 100% a much better position than this, where you're lost and you're still owing people money? So these are the two areas where you simply should not go. Then you have diversification. After the Great Depression, if you have a well-diversified portfolio, very, very rarely has the loss been more than 50%. In the Great Depression, it went down almost 89 or 90%. But the people who held on, didn't panic and hold on, they recovered. Now, if you take the last almost 4 decades in India, only 3 times have we had more than 50%. The first was 92, 93, Harshad Mehta. Second was 2001, 2002, 2003, those 3 years, because of the technology bubble, Ketan Parekh scam, 9/11 terrorist attacks, all coming within 18 months. So we had about 56%. Harshad Mehta was about 54%. This was about 56%. And the recent global financial crisis of 2008, in a 14-month period, the stock market index fell from 20,873 points to about 8,160 points, roughly 60%. So only 3 times have we had more than 50%. So simple diversification, just have it in an index like the Nifty, and you have limited your loss to this extent. Now, diversification itself, when you consider things like this appears to be much better. But it has its limitations because it can only save you from non-systemic risk. If the risk affects the whole market, you're going to go down. So what can prevent you from losing this much? Is there a way to control? Yes. And that is when you combine diversification with diversification across time, or what we call systematic investment. Just as we diversify across stocks, shares, sectors, you need not put all your money in one shot. Send it periodically. And generally you will find, in the Indian context I'm telling you, generally you will find the moment you have a systematic investment plan in a well diversified fund, equity fund or an index fund, in the first year, second year, third year, your losses may not exceed these figures. We will see that in an actual example a little later on. What do I mean by this? You put 1000 rupees into 12 1 year, you have put a total of 12,000 rupees. Generally, your losses will not exceed 30% of 12,000 in a 1 year period. That is 30% of 12,000, let's say, is about 3,600. Let's round it off on the higher side to 4,000. So your 12,000 may read 8,000 after 1 year, provided there is another global financial crisis, not otherwise. And when you extend this for 2 years, %20 of 24,000 that you put is about 4,800. We'll round it off to 5,000. This is what you can generally lose in the maximum in a pure equity fund or an index fund. And 3 years, you have invested this, and you have got this 10%. So it's 3,600. Let's say about 4,000 rupees roughly. So after 3 years, you're not going to be happy, because for 3 years you have put 1,000 rupees per month and you have invested 36,000. 3 years later, your 36,000 is reading 32,000. You still have a loss of 10% or so. What I'm trying to say is, when you employ this plus diversification across time, when you see the kind of loss figures you're getting here and you compare them with total insanity here, don't these look much better? And for controlling your own risk, for decreasing your own risk, you're not paying a consultant any charges. There's no extra money that you have to pay. All this is available to you free. Now, even if you're not satisfied here, then the only thing to do is get to the zero risk level, where you put your principal into something totally safe. Absolute safety. But the income goes into equity. Imagine post office monthly income scheme. You put certain amount of money there. Whatever interest you get per month, that goes into an equity mutual fund. Post office monthly income scheme is guaranteed by the government of India. So it's safe. You're taking a risk now only on the income. And you can't lose all your income, because the stock markets have never gone to zero. In fact, in the long run, it may go up. You don't have to go to those extents. You can also use the simple systematic transfer plans, from the value averaging plan that we saw today to what we have been discussing in the previous session. I had given you the variations of the systematic transfer plan that you can do. My purpose in putting this on the screen is to drive home one very important point. Let's see whether at least I can succeed this time. When you look at the financial markets are like a very large buffet. At the one end, you have all the health foods. There is only one problem with those: no oil, nothing fried, everything freshly cut, no salt, only boiled maximum. Problem is, they may not be up to our taste. So as we are looking at them, we are also looking at the other end of the buffet table where everything looks red, very attractive. Okay, and we are wondering, why are we at this end of the table? Why shouldn't we be at this end of the table? Now, health, food, etc. can tell on your body. This can tell on your financial health. And this is better than you're actually going to a very good buffet, because there you may be disappointed. Here actually you will not. When you choose the health foods, you find that you're very confident. Your risk levels are low. Bad things may be happening to the other people operating in these areas. Those bad things are not happening to you. You'll get to know the value of these kind of strategies in the bad times. I can also tell you that they will look very boring in the good times. But if you can stick to that kind of discipline and have these two simple things, diversification plus diversification across time, I don't really see where you can go wrong. So in the Indian context, the kind of value transfer strategy that I have given you earlier is possibly, for a lump sum investment, one of the best ever presently available options that you have in India. You will be very peaceful. Your investments will not cause you any palpitations. Without you knowing, you can be busy with your work, your employment, your business, your whatever profession. You can be busy there. You can earn your money there. You can devote your time there. In the background, you have got debt, you have got equity. Money is being transferred from debt to equity. Money is being transferred not crazily, not even uniformly. More is being transferred when the markets are down, less is being transferred when the markets are up. When the markets sometimes actually shoot up, you have a runaway boom, some money gets transferred back to debt. All those things means you're operating somewhere here at the very, very low end of the spectrum. So we have choices. Ultimately, it is how we use these choices that will determine whether we are good investors, bad investors, or mad investors. This is the point that I wanted to make. So diversification is very important. Diversification is within our power. We have got complete control on this. And the keys to good investment are lower costs and better pricing, which systematic investment automatically promotes. Systematic investment enables better pricing because more units are purchased when markets are down, less units are purchased when markets are up. Diversification and systematic investment, even when used together, do not completely eliminate risk. They do not completely eliminate risk. They virtually eliminate non-systemic risk and substantially reduce systemic risk. They are very powerful tools. From these levels, even from this level, you substantially come down now. Even so, their importance in risk reduction and returns enhancement can never be underestimated. But if risk is to be eliminated, the strategy of choice is the zero risk systematic transfer plan. Okay. So this is why I wanted to just introduce this concept, or once again repeat this concept of the risk ladder. Whenever we get tempted, some insurance guy comes, we have given 40% return last year, what are you struggling there with the mutual fund, struggling to get 10%? Immediately think, he's trying to sell me something. Where in the risk ladder do I position it? What are the costs? What is the kind of investment? These are the questions to be asked. Somebody is selling you a portfolio management scheme. Why is he selling me a portfolio management scheme at index of 31,000 points? Is he going to take my money and put everything into equity at 31,000? What if the index comes to 25,000 for whatever reason tomorrow? Instead of that, can I not operate somewhere here? Can I not start here when the markets are high? So these are the kind of questions that we have to ask ourselves. Let me tell you an actual incident that happened in our office about sometimes even armed forces personnel, very courageous in real life, but they could get scared of an investment loss. Here was a case of a businessman. He's still a businessman and a good businessman, a canny businessman, a successful businessman. So a successful businessman is obviously a successful risk taker. And there's no businessman who has had a very smooth career. It's always ups and downs. And this man was running a business along with some partners. And that business is quite risky. But he was running it well. He wanted his savings to go into something that is safe. He didn't want to take a risk on his savings, he's taking a risk on his business. I thought there was some logic and sense to that. And he happened to come to our office and make the investment. It was a 4 lakh rupee investment at that time. On the 8th of January 2008. We didn't know, but by hindsight, this was the worst possible day on which you could have invested. Because this was the last day where India was saved from the global financial crisis. From the 9th onwards, the market started plummeting. But when we understood that the markets are at an all-time high at that time, like something like the markets are today, 31,000 or so, very high, at least in relation to their last peak, we told him we will only recommend a zero risk systematic transfer plan. And he was very happy with it. He said, oh, that means even though something is going into equity, there is no risk, no risk. So this is what we did. We put the 4 lakh rupees in something called a floating rate income fund. I've removed the name of the mutual fund. It's one of the leading funds. All funds, the story would have been the same. 4 systematic transfers of 1,000 rupees each were registered. Now, to be generally not have a risk, 1% of your corpus has to be transferred from debt to equity every month. So here it was 4 lakhs, it was 4,000, but I also told you in our last session, you can do a little advanced version. You can do it on different dates, you can do it to different funds. So what were these different funds? One was a large cap fund, one was an index fund. The large cap was actively managed, so this is passively managed. The third was a mid cap fund. And the fourth was a dividend yield fund, investing in companies where they pay a large dividend, plus some small exposure to international stocks outside India. So every one of these funds, different characteristic. Large cap active, large cap passive, mid cap and dividend yield plus some international stocks, just to aid diversification. So this was the strategy suggested to him and he implemented it. Now, I didn't see him for almost a year and a half. I think he next saw me in July of 2009. In the meantime, what had happened? From 20,873, the stock market went all the way down to 8,160 sometime in March. Then slowly started coming up. In July, he came and said, I'm worried about my investment. I said, all right, what's worrying you? Saying, what's worrying me is the whole environment. Everywhere they're talking about this global financial crisis. Everyone is saying it's the second worst financial crisis in the modern history at least. Everybody talks about, I'm out of stocks now. Why? Because I've suffered heavy losses. I don't want to touch the stock market. And you had assured me that nothing is going to happen. This is a very safe strategy. And yes, I believe you. You have that credibility. And I'm sure that what you told me was it was going to be zero risk. But now I can no longer control myself. So I have come to find out what's happened to my investment. I said, what's happened to your investment as of today in July? I'm not going to tell you now. I'll tell you a little later. Because today is not the worst day that you can view your investment. The worst date falls in March when the market was actually down 61%. So we are going to go back to that date and check your investment when having made it on the worst possible day. If you were to withdraw on the day when the market had fallen 60%, what would have been the fate of your investment? This is what we are going to check out. This is what I told him. He was very happy with that. He said, yes, let's go and check that out. Now, this is what had happened. These were the investment values made in, as you can see here, on the 8th of January 2008, 4 lakh rupees invested in a debt fund, 4,000 rupees transferred at the rate of 1,000 rupees to 4 equity funds. 9th March 2009, the BSE Sensex was 8,160, almost 61% down from peak. These were the values. The first was the debt fund. People don't realize when you put a chunk here, this is unaffected by whatever happens in the stock market. This is like almost a bank fixed deposit. So he had put 400,000, 54,000 had been transferred to equity in that period of 13 or 14 months. And that had grown to 385 because it's going to give you some kind of yield like you have on short-term bonds. The Nifty index fund, in 14 months, 14,000 rupees had gone. It was 9,891. Even here, if you work out the percentages, you'll find all the losses are between 30 and 35%. Whereas the index had fallen 61%. Not for any other magic, simply because it was systematic. Everything didn't go on one day. Same is the case for the next fund, the large cap fund. You can see only losses over this period. And the mid cap fund. And finally, the other fund that we're talking about. Every one of these had been battered. But when you did your totaling, you got this figure of 422,000, 4,22,000. Because we started from a position of total safety. We started here. Having started here, we started on the day the global financial crisis is now going to crash upon us like a mountain crashing upon us. Now, if you think I'm impressed by those figures, let me tell you those figures are utterly unimpressive. Why? 14 months have passed. In 14 months, 4 lakhs has grown to 4,22,000. Equal to roughly savings bank interest, maybe 4% or something like that. So returns wise, a disaster. But when you look at it from another point of view, you put 4 lakhs, top to bottom, stock markets have fallen 61%. Your investment is 422. Had you put the entire thing in an index fund that tracked the sensitive index, your 4 lakhs would be 1,56,360 in that period of 14 months. Now, when you look at this, and this is what he's hearing when he opens his newspaper or switches on his TV, goes to his parties, his neighbors are crying, his family members are crying. In fact, there's nobody who is not crying. This is what is happening to him. And I can never forget his words when he left our office. It was in the afternoon, I still remember, almost about 2 when I was going for lunch, my last appointment in the morning. He only kept asking me one thing. Are you telling me that if I now close all my investments and get out, I'm going to approximately get that figure? I said, yes, that's what you're going to get. Here are the values. The report is there. I can get you the statements from the fund. So he kept on scratching his chin. And finally, when he left the office, he tells me, then what is this global financial crisis that everybody is talking about? The markets will give you these things. What did you choose? If we had chosen this, of course, for him, 4 lakhs was a very small amount. He has invested a lot more. The 4 lakh investment was on that date. The other investments are not on that date. So then you can lose only less. So this investment was done on that date, this one installment. So this is what we checked up. We could have chosen this. At the height, there were any numbers of derivative traders coming out with so many strategies. We could have chosen even diversification. He would have been hit by about 60%. So this is important. Your approach, it is us. Risk is not in the markets. Risk is not in the markets. As Jason Zweig, I never tire of telling you. Jason Zweig, as he beautifully says, if you want to see what risk is, step into the nearest bathroom mirror and look into it. That is risk. Risk is us. We see ourselves there. What do we choose? How do we behave? So when you are confronted with a risk ladder, the risk ladder is a very funny ladder. It's not like your normal ladder. If your normal ladder is leaning against the wall, unless you're some kind of Olympic pole vaulter, you can't go and fall on the top step. You have to start from the bottom step and climb the ladder. But imagine for a moment that there's this one magic ladder which gives you an opportunity. If there are 15 steps there, you can go to whichever step you like. So if you want to go to step number 15, you have to just press a button, select a menu, and suddenly you find yourself on the 15 steps. The financial markets are like that. They give you that choice. You can press the button. Do I want to be here? Do I want to be here? Do I want to be here? Anywhere in between. They give you the choice. If you look at the normal behavior of people, there is a ladder. Yes, I want to climb the roof. But I don't start 50 meters away, come running full swing and try to take one leap to the top. I will slowly climb 1, 2, 3, 4, 5 steps. Let me see. Okay, I've climbed one step. I'm still alive. So I climb the second step. Okay, not bad. Third step. Now, as people who have got a slight fear of heights, when they are 6, 7, 8 steps, and if they look down, then we have got a problem. Very good example and very good attitude towards financial risk. You climb here, you're here. All these are very beneficial to you if you stick with the program. If you stick with the program, relatively low risk, you will get the rewards. But if around this level, I'm beginning to feel, okay, this is enough, stop here. Stop here, don't go beyond this. Stop with systematic investment. If even this is causing you a lot of anxiety, stick only here. You will not regret it one day. So this is something that we have to always understand. In a crisis, you realize the importance of risk management. A crisis has to occur, risk has to occur. Then you realize its value. Like in financial planning, when we talk about something called emergency funding, the value of an emergency fund you realize only when there's an emergency, not otherwise. Dr. Raghuram Rajan has a beautiful saying, not taking risks one doesn't understand is often the best form of risk management. Not taking risks one doesn't understand is often the best form of risk management. A lot of clients, sometimes they cannot understand this concept of the zero risk systematic transfer plan. So many times they come back to me and say, what if we keep our money in the bank deposit? The interest, let it go to equity. Okay, if that's what's going to make you comfortable, it is better than a cumulative bank deposit. Because I know over a 5-6 year period, the equity portion will probably give you more. Start with that. As you get more comfortable, you'll suddenly realize we do give them the normal cautions. Understand that your bank deposit interest is fully taxable. Where are you in tax? Sometimes a non-resident Indian, as it happened about 2 years back or 3 years back, they were getting 9%, 9.25%, even in one case 9.5% on an NRE deposit in the main banks. And some of them have kept 10-year terms for those deposits. So they came back to me and said, somehow we are not very sure about what a debt mutual fund is. Equity mutual funds we understand. So can we keep our money in an NRE deposit? We are non-residents. I said, okay, you can do it. Because that is tax-free. Not a problem. The interest, send it into systematic investment plans, into equity funds. This is all common sense. So long as you concentrate and focus on safety, you may not regret. You may not have too many regrets at all. There are times when you start here, let me make it very clear, you don't have to continue to be here. When you start here, today the index, let's say, is 31,000. But tomorrow if the index by some chance falls to about 22,000 or 23,000 or 25% below it, then you can increase the rate of your transfer from debt to equity. You can take a lump sum from debt and put it into equity when you hit the 25% level. If by some chance you have another opportunity for 50% fall, you can transfer everything from debt to equity at that time. That time there is no risk in the market. You have options. Just because you started out with a very boring and disciplined strategy doesn't mean it is not flexible. Please understand that. But on the day I'm putting my money into an investment, what is the stock market index? What was its last high? Am I very close to that peak? If I'm there, shouldn't I be cautious? Shouldn't I be cautious? On the other hand, if I have this good fortune of coming into some money when the market is already 50% below its peak, then you need not ask somebody, just put everything into an equity fund. You need not even choose systematic. Go directly here. Go directly here. Because when the index itself is down by 50% from its last peak, there's no risk here at all. So you have options. Investing is flexible. A common sense approach is what is required.